This is the straight line method of depreciating a truck. Given the information, we get a $32,000 truck. We know that it's going to provide useful service to our company for the next 4 years, at least that's our estimate. And we think when we are done with this truck that we can sell it for about $2,000, and that would be the salvage value. So using a rational means of allocating the cost of that truck over its useful life, the first one of those is the straight line method. And so what we do is we start with the cost of the truck, the $32,000. We deduct the salvage value. So we deduct the salvage value from that, and we get what's called the depreciable base. Okay, this is the depreciation base, depreciable base of the truck. So we could go depreciable base. Okay, so we have that. So we go in cost less the salvage, the estimated salvage, and that gives us the depreciable base. We simply divide that by how long we think the truck is going to last, and that would give us an annual depreciation expense of $7,500. So we have this truck that's going to supposedly last us the 4 years. So each year we're going to take an expense, depreciation expense, of $7,500, and that allocates the cost over its useful life. Journal entry to do that each year with straight line would be depreciation expense, which goes on the income statement. And that would be the debit of $7,500. And then the credit is to an account called accumulated or piled up depreciation. So we're just accumulating the depreciation. Accumulated depreciation. And that would also be $7,500. Okay, so depreciation expense is going to be reported on your income statement as an operating expense, just like utilities and rent and everything, because it essentially helped generate the revenue for this period. Accumulated depreciation shows up on the balance sheet. So on the company's balance sheet, you're going to have the account truck. You might have equipment, and we want to keep the truck on the books at its original historic cost of the $32,000. Okay, notice it's not the 30, it's the 32, the original cost. And then it's going to be reported less the accumulated depreciation. And so far, we've accumulated only $7,500. So that gives us what would be the book value, and it would not say book value on the income on the balance sheet, but it would give us the current book value of the truck of the $24,500. Okay, so this journal entry would be made each year, and so you're going to have the truck on the books, and the truck is going to stay on the books as long as we have it at what we paid for it. But the accumulated depreciation, that account goes with the truck. Okay, so it's accumulated depreciation for that truck. In year 1, we've got $7,500 in it. Okay, at the end of year 2, we'd make the same journal entry, and we'd have another $7,500. Except now, when you go to say in year 2, truck less accumulated depreciation, now it's the total of these two. Because you've accumulated $15,000 in depreciation, and so now your book value reflects the fact that we are, using up this truck. So now you have a book value left of $17,000. We're going to depreciate down to the estimated salvage value. So I think on my notes you can see how this would go out through the rest of the year. So that's your basic straight line method, and I'm going to do a separate video for the next one, which will be the units of activity method.